Good afternoon. I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. Welcome to our In, At, and Out of the Money Options webinar. For anyone who missed our previous webinars, give us a call and we can send the videos you missed. First things first, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read all disclosures before investing. If at any time during the webinar you have a question or trade ideas, please type them into the chat box and we will do our best to answer them. Also on the line today is Adrian Mueller. He's the founder and principal of Time Leverage Capital, who is chief strategist of Dow Jones Megatrends, an all markets newsletter, and lead developer of the Option Ranger software. Mr. Mueller?
Okay, thank you, Roy, and welcome aboard, everybody. It's a very exciting Thursday. Some of you might be huddled up in some cold climes, and we're seeing the S&P and crude oil get very volatile. So during a week when we discuss volatility in the markets, it's very interesting to see some of that volatility. We had a review a couple of days ago on volatility in general as a principle, and today's session follows up very closely on that and the different types of options, the classes of options that you can use to figure out, based on your volatility outlook, how to select a trade. Again, just for a quick review on volatility, and we'll go back to something that is emotionally wired into all of us, or many of us, is some of the big moves in the stock market and the volatility that accompanied them, and to bear in mind how those volatility expectations are going to affect our selection of options and classes of options. As you can see, and we have a full discussion of this from a couple of days ago, when a major market move occurs, or there's a panic, or there's some anticipation of a major move or a crisis, as you can see, the market volatility goes up. This is the actual historic volatility. When options are trading, what you see in them, and we'll go over the definition, is not so much what has happened, but rather what is the expectation in the marketplace. During periods of very low volatility, as you can see over here, there's no major anxiety or expectation of large moves. So the markets are more tame, and the expectations of speculators are not as expansive as to the size of move that they expect. Then, and especially during panics and significant downtime, so you look at the Lehman Brothers crisis, look at the Russian debt crisis to a smaller extent, you look at the 9/11 terrorist event, the internet bubble, the flash crash, and so on. All of these significant drops were accompanied by rises in actual volatility. The question is, ahead of the event, how can you trade options and attempt to understand or anticipate the volatility so that you can pick the right option for that situation? So again, to move into the world of reality, we're going to open up some of our reference sections on the Option Ranger calculator and proceed with some actual examples of strike prices as well as some charts. For today, we've actually set up some trades under a special tab called Strike Price Demo, and we can set up these tabs for you depending on where you are in your learning. And we're going to use the March corn contract to illustrate the purchase of both calls and puts, how they're valued, and what we can conclude about what the market is expecting, what kind of volatility is being factored in, and whether or not we see an opportunity for a discrepancy that could work in our favor, and also, of course, to look out for any discrepancies that we should be aware of as a risk factor. So now that we're going to open up these examples in a minute. The trades have already been placed, so I'm not going to go over the illustrations of how to input the trades. If you'd like to learn how to do that, you can go ahead to our demo videos in our demo section under Reference and Materials, and you can also set up an appointment with customer service or one of our APs or trading mentors. So for now, as we go into the different classes of options, let me go ahead first and pull up the different categories of calls and puts. This comes from our option reference sheets as strike examples. We have a definition of in the money, at the money, and out of the money options. And that differs on calls and puts. In the case of calls, a deep in-the-money option is well below the market. An in-the-money option is somewhat below the market. At the money is where the market's trading more or less. Out of the money means that the market price is below the call that you're buying, so it needs to make up ground and is entirely made up of volatility, an important thing to keep in mind. And deep out of the monies are what would commonly be referred to as long shots or cheap options. As we know, long shots are not always the way to bet, but sometimes they do come in. So whether you bet on a long shot or you bet against it, you should be very mindful of the risk-to-reward ratio. And when you look at this grid of in, at, and out of the money options with these definitions, it'll be a great refresher. The way to learn visually, however, and this is the subject of many studies and information, is to actually see examples and to assimilate the information not just through wording and graphs, but through actual prices. So today we are going to be using the March Gordon contract, and you're seeing it here on a daily chart, to illustrate the purchase of some call and put options and analyze the volatility and the expectations that are built into the market. And then people can assess whether or not they think those expectations are reasonable or whether there's some kind of a discrepancy where you can take advantage. So let's look at the basics now. This is a daily March corn chart. And today's prices, as you can see here, settled at $4.33.5. That's $4.33.5. When you look at the different options that are trading, and I pulled up an option series here, as you can see, let's go right. The closest strike that we have to this is the 430 strike. And as you can see, let me just go ahead and bring us to the 430 strike. And we're going to look at the calls first. The 430 call on the March contract, and again, we input our numbers before they settled at 8 3/8. So that is the settlement price. The market being at 433.5, but the option itself trading at 8 3/8, let's call it 8.5 to make life easy, is factoring in approximately a move to 438 3/8. Let's call it 438.5, whereas the market itself is only at 433.5. 3.5 cents above that 430 price are what's called in the money or intrinsic value. Because if the contract were to expire today, you have the right to buy corn at 430. The market would be at 433.5, which means that you would still get 3.5 cents back. So what is this other 5 cents, or 4 7/8 of a cent? The difference between how much this option is in the money, which is a 3.5 cent difference between 430 and 433.5, and the actual price of the option today, which we'll call it an additional 5 cents to round up, is that the 5 cents is the implied volatility, not as a measure, but rather it's the volatility value of the option. It's the time value of the option. So that the buyer of this option at 430 is essentially, in addition to the intrinsic value of 3.5 cents, which it would be worth at expiration, they are betting that during this time, between now and expiration, there's at least another 5 cents worth of a move in this market, or shall we say 5 cents plus whatever the transaction costs are. the person who is selling this option is collecting an additional 5 cents above its intrinsic value because they are betting that the market will not go there and it's going to go down. So in a case like this, and if you look at your definition of in, at, and out of the money options, again, you're going to see that this would be an in-the-money option by 3.5 cents. The strike price is below the current price of the market in the case of a call, and the difference, which is the volatility value, is approximately 5 cents. If we take this trade now and we take it to the option calculator, and I believe we didn't have the settlement prices when we input it, so we input it as 8 cents. Okay. So what we have here now is, let's look at the spreadsheet using 8 cents, ended up being about a ½ cent more. In this particular case, 3.5 cents are intrinsic. Where's our break even on the trade? The bet on this by the buyer of the option is that he would have a break-even of premium with commissions factored in at 55 at 9.1 cents, which means that he's expecting the market to be at 439.1, whereas here we really have the market at 433.5 on the close. So they are betting that there's going to be more than this much of a move to the upside, either in the futures or in the option, for the trade to become profitable. Why is this person paying this volatility or premium, or taking on this handicap, if you will, in competing to make money? Well, the main reason is that by buying this option and paying that premium, the risk is limited strictly to the cost of the option, the total cost, which is premium plus fees. In this case, it was calculated as $4.55. So in exchange for the approximately 5 cent handicap that this person is taking on against the futures price, they have the pleasure of knowing that if the market goes down significantly, they cannot lose more than they spent. And that since they only have since they're already 3.5 cents intrinsic, hopefully they will have some time value, even if the market doesn't go their way, to salvage some premium. This option then would be an in-the-money option, and it would be a slightly in-the-money option. This would not be a deep in-the-money option because it's just barely above the nearest strike price. Now, the great thing about this option, if you look at it, is because, again, when you buy an option, you're looking for rising volatility and an upside move if you're buying a call. As you can see, moves that appear not so big could yield a fairly good result. So somebody might say, wow, well, just on a move to 448, 446, it's a pretty good return considering the low level of risk on an option that's already 3.5 cents in the money. On the other hand, this is a March option that is expiring quickly, and if it doesn't make its move with rising volatility, time erosion is going to take its toll, and arguably, not that it's going to happen, but if you were to take a picture of this market and on expiration it stays exactly where it is, it would be worth the 3.5 cents that it's intrinsic on the futures. Let me go back to the number. It would be worth, the 430 would be worth the 3.5 cents that it is above the strike price intrinsically, and the additional 5 cents that were spent on the option would erode. So on a quick expiration, that time erosion could work quickly. On the other hand, if a speculator were to look at this chart and come up with a scenario of a very large upside move with rising volatility, there would be a great amount of inducement for them to say, wow, prices have been much higher before, and if they don't think they have sufficient time in the March contract, they could go to a more deferred month in case they think that some of these market moves are going to be retraced. In any event, as you can see, the time value and the premium on this in this particular case shows a market with relatively low volatility, and we can show you charts, and you can pull up your charts yourself in which you see volatility. Now let's go ahead and follow another example So this person is looking for a decent size upside move. Doesn't have to be a huge move. If they get 15 cents, even 10 cents above the current price, they're going to have a short-term trade that can be relatively profitable. If it doesn't work, they have to bail quickly, or they could lose their entire premium as expiration is looming around the corner. Now, let's see, for instance, another person who would buy an option. So now we have looked at the purchase of the 430 call. Now let's look at the purchase of a 440 call. Again, as you remember, when we pull up a trade, you get the specifics of the trade and your expectations, in this case looking for an up direction with rising volatility. Since you're buying the call out of the money, now this is a 440 call, as you can see, your cost is less. Your cost is lower than the 430 call that was in the money. So your total risk now, and that's why you're paying a premium, is limited to $255, including the commission that was used here as a default. However, in exchange for having a smaller cost and by buying an out-of-the-money option at the next strike up, your break-even goes up. Now your break-even is lower. It's 5.1 cents because you spent less. However, on the futures, to be intrinsically profitable, you have to be above 445.1 rather than 439.1, which was our number in our last example. So the 440 call, while it is cheaper, as with everything, since it's more of a long shot than the 430 and is out of the money, is going to be cheaper, but it's also going to require a larger move to be profitable, while on the contrary, losing less money if the market does not go anywhere. So here you would have to be more bullish because this option is 100%. This option is 100% volatility. Since this is an out-of-the-money option, this means that it has no in-the-money value. The market is at 433.5, which is below the 440 call. So just to get to be at the money, this option would have to go up 6.5 cents. And let's go quickly to our visual, and let's click on the 440 call. And now, as you can see, that option actually settled cheaper than we had listed here at 3 3/4, but we'll use our example as an example. And as you can see now, 440 is marked at 433.5. So you need a move of 6.5 cents just to get to your strike price of 440. Everything's out of the money. Whereas in the case of the 430, we were 3.5 cents in the money. Now, the farther you go in price, you go to a 440 call, let's say you go to a 450 call, which is even farther out of the money. Now your market, just to get to your strike price, would have to go over here, and you still haven't overcome the cost of your trade. So on the one hand, you can say, wow, well, you know, this option, the 450 call, is real cheap. If it settled out at 1.5 cents, oops, we're not buying it, not to worry. That's why you have to be very careful when you use a platform. You hit the wrong button, and all of a sudden you're in a trade, and you could be very happy or you could be very sad, depending on the outcome. But you certainly don't want to trade by unintentionally. So now we have this option settled, the 450 call that's out of the money, settled at 1.5 cents. Now let's see, how much is this call out of the money? From 433.5 to 450. We have 16.5 cents. So the market would have to go up 16.5 cents just to get to the strike price and to be at the money. And if it doesn't do it quickly, with rising volatility, that option could erode worthless. Again, when you look at a long-term chart, you might say, well, it's not such a bad bet. The market's 450 is right here. We've been much higher. Remember, these options expire, and time erosion is a factor. So it doesn't do you much good to to have the right, but not the obligation, to buy the contract at 450 if it's going to get above 450 after your option expires. So in this particular case, again, because we want to be mindful of what's going on with the trade, we would go to the calculator, and I'd like, again, we save trades in the tab. We overpaid for this option for the example. We can use the actual price, but this is for illustration purposes, not to try to make a trade look good or bad. And as you can see here, what is the advantage? Well, this option now is really cheap. So definitely when you trade in cheaper options like this, be sure to ask your broker for a discount. I think it's very reasonable, and a broker will certainly do that for you if he has the ability to do so. Now again, in this case, we're buying a real cheap option. It's 450. It's out of the money. I don't know if it's deep out of the money, but it's certainly out of the money. And now the payoff for any long shot, as you know, is that it costs very little. In this case, 155, including a commission. That hasn't been discounted, but just for illustration purposes. And as you can see, the market can tank through the floor. All you can lose is 155. And you've got yourself a long shot that if the market really takes off on a tiny risk of 155, you know, if the market really takes off, you can make some very decent numbers. And in fact, just for illustration purposes, if you were to reset the output rows, which may not be realistic for a move, but it's to illustrate, again, the downside is limited, but on some kind of a move to the upside, on a move to just 467.5, a risk that trades 150 could net 720. Again, I think that's an unusually large move in a very short time frame, but it gives you the reason why people buy cheap options out of the money. They're a long shot, and the downside to a long shot is that they usually lose. The upside to the long shot is that although they usually lose when they come in, they offer a pretty significant result. So now we have covered on calls an in-the-money call, an out-of-the-money call, and an even farther out-of-the-money call to show you how, as the cost of the option goes down, its likelihood of making profits based on how close it is to the money also goes down. So the farther out of the money you are, the less you pay, which is good if you're buying options, the less your risk, which is good if you're buying options, but the larger the move and the greater the volatility that is required to make that trade work out. When people trade spreads, in many cases, what they try to do, and I'm not recommending this as a trade because I don't think it works, is they might take an option that's in the money, that's very well valued, reduce their cost by selling an option that's out of the money, buying an option that's undervalued and in the money, selling an option that's too volatile and overvalued out of the money, and reduce their entry cost as a spread. Again, we're not going to go into that, but in this case, again, we would be combining an in-the-money call that we would be purchasing or long and selling or shorting an out-of-the-money call to create, in this particular case, it would be a bull spread.
Mr. Mueller?
Now, to work, yes.
We have a question, actually, before we get too far away. If you believe that corn is going to rally on rising volatility, would you be better off buying 2 440 calls instead of 1 430 call?
Okay, a very good question, and that's where the calculator comes in, because I can give you, what we can do very quickly is do the following. We can just take our current calculator, and that's one of the features that we built into it. We can put in the idea of purchasing 2 440 calls, okay, and we're making these changes on the fly, and let's say those calls were costing let me see just a moment. We input 4 cents, so let's keep it consistent at 4 cents. Okay. Now let's do the calculations. On this particular, and then we can actually compare buying the 1 430 and buying the 440 and seeing where the numbers make the most sense. So let's go back to the 430 Okay? And when we go back to the 430, let's see where we start making money. And this is where you have to have an opinion. Let's say somebody says, I think this market's going to 450. And you have to take a position of sorts when you trade and know which makes sense. Well, on that bullish theory, the two positions, let's go back here. So now we have one 430 call at 8. At 450, if that's your expectation, it would be worth $545. You'd be netting $545. Bear in mind you're paying an extra commission, so you want to factor that's already getting factored into your profit and loss because that's part of your expense. So now if my goal is there, I would probably write down 545 or skip back and forth between the safe trades. Now let's see what happens at 450 if I buy two 440 calls at 4 points. And of course, you also have to compare your costs. Remember, now in this particular case, you're buying two options, and because of the extra cost, it's a little bit higher. Now, when it moves to 450, you would be making 490. So the one lot on a small move, especially because of the extra commission cost, on a move to 450, generally speaking, on in the money or intrinsic value would actually be more to your advantage. And it's a close call primarily because of the commission savings. On the other hand, if this market were to make a really big move, and let's say your expectation would be for, let's say it's 460, then your two lots that you picked up would be netting 1490 after commissions, whereas on the, and this is why it's good to have these saved trade tabs over here. So whereas on the 430 call, and again we can compare side by side, you can write down the numbers or skip back and forth. On the move to 460 in this case, it's 1,045. So the out of the money options, the cheaper money options, gain more on the bigger moves with rising volatility. The way you decide on an option, whether you go closer to the money or in the money as in the 430 or somewhat out of the money as the 440, as you can see here, and it's a pretty good example, is that when you go out of the money, you need a larger move. So you are being more speculative, you're spending less if it's the same number of units, but on a large move you can make significantly more. On a smaller move, on the other hand, you have to be very mindful that if you're going to risk, in this case, on the two lot, for $455, you should have in mind at what futures price are you going to give up on the theory that this market is going up with rising volatility and walk away and cut your losses by maybe salvaging a couple $100 on the trade instead of watching it erode to zero. So in this particular case, the answer to the question is if you're expecting big-time rising volatility, you can go farther out of the money. If you expect volatility to go up, but not as extraordinarily much, then you should go at the money or even in the money with an option. The deep out of the money options, like all long shots, are the home run plays that rarely materialize. And a lot of people, that's why a lot of people try to play the in the money or at the money options and try to use the high volatility out of the money speculative options as a way of reducing cost or hedging direction somewhat. If that answered the question, and again, it's the same thing. If you were to go ahead and do the example, let's do it quickly. Look at the difference on the 450 calls, just to really complete the example. Just give me one moment. Just one moment. Here we are. Now let's look at the same comparison of buying one 430 call and switching to, so let's say, well, how about if you buy two 450 calls? Okay, so let me go back there. So all you do is you change the number of contracts to 2. We'll leave the premium the same, the strike price. I'll leave the commission there again, although for these options, again, you should really be able to obtain a discount. I know that we offer that when people buy cheaper options. And let's have a look at a comparison again against the 430. Now you're going to see that even on a 2 lot, you're spending and risking less than you did by buying 2 440s. But in order to break even, you need this trade to be in the money or intrinsic above 453.1. Or the break-even on the premium is 3.1. The other break-evens were lower. So here, why would anybody do such a thing? Well, they're spending less. They got a 2 lot. But if you look at the relative money spent, and let's go back to a larger move, once the initial premium cost is overcome, and if this move is rising volatility, but really explosively rising volatility, let me go ahead and finish the calculation on more rows, and you can always reset the number of rows based on how far you think the market will go. Again, no matter how low you go, the risk is the same. But as you can see now, if you get a pretty significant move, the numbers are pretty big. So you get to your 467 number, you're talking about 1390 on a lower investment and on a larger move. One of the important things to do, and in order to really trade as a business, is to look at these spreadsheets as we are looking right now and make sure that the place that you select for your trades, whether or not you are correct in your expectation, that at least you are trading in accordance with what you really believe. What happens, unfortunately, let's say using the example of buying these out of the money 450 calls, is that somebody's expecting corn to go up. And corn, as we indicated before, is at 433.5. So they're saying, well, you know, corn's at 433.5. And they say, you know, I really think it's going to go up. So they're going to buy this 450 call. And the market indeed can go up. But if it doesn't break through that break-even of premium, and if it doesn't break through that break-even of the futures price, the person who bought those options out of the money, if they don't act and don't salvage premium, can be correct about direction. They can be correct that the market's going up. They bought call options in March. And yet, they can still lose money because the move wasn't fast enough and big enough to get them where they need to be to actually make money. And that is why, as you can see, and let's look up and down the calls and different strike prices, why the strike prices, and let's go to the call side here, if we may, as you can see, the closer you get to the money, the deeper you get in the money, almost did another trade, the higher the price of the option. And here, if you look at, so as you look at the 430, it's slightly in the money. The 420 is even more in the money. But the reason the 420 option is worth 15.5 cents is because 13.5 of those cents are in the money. Because if the contract were to expire today and get exercised, the difference from 420 to 433.5, you would have the right to buy the futures at 420. If today was expiration day, you could sell them at 433.5. So that would be worth 13.5 cents. That would be 13.5 cents. So the only time value or volatility or spec value that you're paying on that option is 2 cents above the intrinsic value. And that's to totally reduce your risk because you're not paying the futures. The reason this is so reasonable is because this option in this market at this time is being treated as a deep in the money option that's close to expiration. So while you have premium that you can lose on a severe drop, you still lose 15.5 cents total plus your transaction costs. there's a significant difference between here, where you're 13.5 cents intrinsic and pay 2 cents in volatility premium. This trade, the 430, where you are 3.5 cents in the money and are basically paying 5 cents in time value or premium. And the 440, where you are paying 3 3/4, all of which is time value or volatility premium. Because if the market were to expire today, and the market's at 433.5, and you have to buy at 440, you wouldn't do it. You would just abandon the option, let it expire worthless, and the person who sold that option, which is why the reason people sell options, would turn around and say, okay, I kept that premium for myself. And again, that would depend on where it expires. So you see here a very clear example where you can compare the in-the-money value of an option, strike price by strike price against the volatility value, look at a chart, look at your expectations on market, and then get a very specific and reasonable spreadsheet that tells you intrinsically and on premium where you can win and lose, and where you would risk losing. The important thing here again is that it puts you face to face with the reality of how much does an option have to do. So an inexperienced trader, even an inexperienced broker, is going to say, one's going up, look how cheap the 450 call options are, let's go buy them. And then if they don't get that move with rising volatility, they end up losing money. And that's actually one of the reasons that this was designed to show immediately upon looking at this, about inputting the trade, that we provide a profit and loss graph with a time decay description. And as you know from looking at our basic demos, you can click on that and get more information on how the trade will operate. Now, puts are the same, only in reverse. So let's go ahead and take a minute, and you're going to see, as I'm sure you already expect, how the examples are the same. So first we're going to look at a 440 put. And just to make things clear, let's go back to our chart. Let's go back to our chart for a moment.
Mr. Mueller, we have one more question.
Sure.
Can you ever reach your break even if an option, even if it doesn't go above your strike price? Can you ever reach the break? Can you ever reach the break even in an option, even if it doesn't go above your strike price?
Absolutely. That's why in the calculator, if you look, we have 2 measurements of break even. And let me go back to the break even box, and you'll get more and more familiar with this because it's all written. We're just going to have to look at it. As you can see here, there's a break even on the futures in this particular example, and there's also a premium of break even. The premium you have quoted all the time. You have 24/7 access to premium quotes. So at any time that the option premium goes above 12.1, in the case of this particular case that we demonstrated, you are in a profit. The reason we show the futures and intrinsic value is because that you really have to have that sense of opinion about a realistic move before you invest in premium, and it's the only objective way to know where does this thing pretty much for sure start making money. But let's say, for instance, you have this market go up significantly with rising volatility and does not exceed the break-even on futures, and you monitor the premium, it can get closer to the money, and its volatility can inflate enough to become profitable. So let me give you an example on this using this 440 call option that we used in the corn, which is presently out of the money. Let's say, for argument's sake, and we have a current quote on that, and its settlement price that you saw was actually under 4 cents. We're calling it 4 cents for educational purposes. Let's say the market goes up. Let's say it goes from 433.5 goes up 6 cents tomorrow to 439.5, and it's still out of the money, but it's closer to the money now. Instead of being out of the money, it's closer to an at the money option, and it's a volatile move. Maybe the move occurs because some rumor comes into the market that we didn't think of today or that we didn't expect. So the market goes up 6 cents because there's some kind of a rumor that China is buying corn. Well, between the price move and the rumor, which increases excitement and volatility, this option could be inflated and become profitable while the price is still under 440. This is because the premium can go up and down with the market and with volatility expectations, and that's why it's always very important when you are trading in these markets, not just to look at the futures prices, as many people do, but also to look at the premium at all times. For example, in a trade like this, if a move like that occurs, you can do many things. One thing you could do is, let's say you had the price get up to near 440 or to 440. You're certainly not in the money on it. You're just at the money. But with volatility and everything else, let's say this option is worth, goes from our break-even of 12.1 cents to, let's say, 16.1 cents. And I'm not saying you would increase that much. That's just a speculation. Let's say call it 15.1 cents. But you made $150 net. And you have to decide, is that a sufficient gain? On a percentage basis, it's certainly a profit that one should consider taking if the position goes up. And let me go back to the 440 call that we're discussing rather than the put that I was going to. So again, so you might look at this 440 call. Excuse me, let me use the actual example. Pardon me. So let's say you're on this 440 call, and the market runs up 6 cents some more. You're at 439.5. You spent 4 cents, maybe out of China, it's worth 10 cents. All of a sudden, that's why people get into these markets. You don't have to wait till expiration. You don't have to wait for the futures to go in the money to get to your break even on futures here, 445.5. That option could be worth enough money to become profitable and offset. Remember, this option is worth money today, and it's out of the money. So an out of the money option is traded and has value. An at the money option has additional value. So if the direction goes up, and in this case the direction and the volatility goes up, your call option can be profitable and can be offset even before expiration. By the same token, if the market doesn't go your way, and you don't think the market's going to get to your desired price, you can offset before expiration, not just in order to take an early gain, but you can also offset before expiration to try to salvage and to minimize your losses so you can come back another day. The great thing about these markets is that they're very liquid and very actively traded. So absolutely, there is time value in an option even before it's in the money, and with volatility and volatility increases, you can go into a profit even without offsetting. In fact, let me even go so far as to say that sometimes prices may not move at all, but the volatility goes up. So let's say today the market is discounting 4 cents. The line or the odds are basically that somebody is willing to collect 4 cents or $200 to bet against this market going to 440 and above. Another person is willing to pay 4 cents to bet that it's going to go beyond this level. So you have two different sides taking a position. Imagine, if you will, that there's some kind of news that there's an announcement coming out. And let's use China again as an example. And one set of rumors is that China is going to announce that they have extraordinarily huge production, and they're going to be exporting corn in a big way. And the other position is that China is going to make this announcement, but what they're actually going to say is that they have a shortage, and they really want corn, and they're going to start producing ethanol, and they want to increase their livestock supply, and they're going to be buying corn like crazy. Now, there's no clear story on what's going to happen. People can have opinions, but because expectations of volatility increase on both sides, this option could increase in value without the market moving, because the guys who think it's going to go up are going to be buying it. The people who think it's going to go down are going to be selling. into a narrow band, as we showed yesterday. And then when the news comes out, there can be a breakout. That tension, that disagreement, that expectation of a large move in either direction could pump up the volatility on this option to the extent that without a movement up in the futures prices, the option itself could become inflated strictly because of the volatility value and become profitable that way to be sold. And that is why volatility is so important. If you'll remember, and let me just take you briefly back to our strategy section, if I may, to our strategy gallery. There are many trades, and there are certainly many expectations that we can have. Let me just go there for a moment, in which a person may have no sense of direction. Remember, it can be bullish, bearish, or undecided. Nonetheless, even if you don't know where the market's going, if you have a volatility expectation of any kind, whether you think volatility is going up, whether you think volatility is going down, or whether you think volatility is going sideways, with no sense of direction, if you have no idea other than that volatility is going up and no idea of direction, there are still ways for you to capitalize on that opinion and to profit from it if you're right, and or at least to compose a trade which would profit from having no clue whatsoever about direction, but having a strong and reasonable opinion about volatility. So that's why we always emphasize the volatility portion and post up the reminders the minute the trade is input of what the volatility outlook is and how that outlook is affected by the one thing that for sure will affect option value, which is time decay or time erosion. Because what makes the difference between somebody who buys, and let's go back to our examples here, who buys a 430 call because they're expecting a smaller move, the 440 for a bigger move, the 450 for an explosive move. All these people have an expectation of a movement occurring over time. The less time is left for that move to occur, the less reasonable it is to expect a large move. So volatility and time erosion become real factors as the amount of time available diminishes for the desired results to occur. That's why a lot of people play the opposite side of time decay. So for instance, a speculator is going to turn around, and we actually did some examples in our last session on selling calls. I don't know if the examples are still here. So for instance, we did some examples of not people not buying calls, but rather selling calls, in that case expecting the market to go down or expecting the market to stay flat with diminishing volatility. Of the two, what's happened, of course, is that largely the market went down. I don't know if anybody did those trades or whether or not they offset them. Again, it was just for illustration purposes. So let's resume now, if I may. If that answered the question, and again, watch the premium. You can make money. You can make money. Just watch the premium. The calculator is to give you a sense of what's realistic in the futures while also emphasizing and calculating precisely what your premium break-even point is. So when you go to your platform or you go to your online forums or you talk to your broker, you can get a premium quote on that option and you immediately know if you're in the clear or not without having to go to that futures price. And then you can offset early, again, whether it's to lock in some sort of a gain or to walk away from something that's not looking so good anymore. Now let's just very quickly, in the class of puts, we're going to do some examples, and let's go ahead and look at the buying Acorn 440 put. And as you can see here, let me go back to the top here where the trade is calculated. The cost, including commissions there, would be $550. Again, when you look at the profit and loss graph here, now it's buying a put, so it looks a little bit different. It's flipped from the long call. But you see again that it's a trade which you may have a different directional expectation. Now it's down instead of up. But because you're spending premium, time decays against you, so you're looking for volatility to go up. So you're not just looking for that market to go down, you're looking for it to go down with increasing volatility or explosiveness. And again, on this trade, the 440 put, as you will recall, is 6.5 cents in the money. Let me just pull that up as a reminder. So if the market's at 433.5, and you are buying a 440 put, actually settled at 10.25. So let's see, at 440 put at 10 and let's call it 10 cents, means that this is in the money, 6.5 cents, and the difference, let's say it's 10, is 3.5 cents. So you're in the money, 6.5 cents. This would be an in-the-money option as a put because it's above the market. And if it expires today at 433.5, it would be worth 6.5 cents just because it's in the money. And you have the right to sell corn at 440. You have the right, but not the obligation. And the market's at 433.5. You can go ahead and sell it at 440, buy it back at 433.5, and that would be intrinsically 6.5 cents. So in this particular case, the difference, which is to 10.25, is basically 3.75 cents, if you will, which is the time value or the volatility value of the option. Again, so in this particular case, you're looking for the market to drop, but because you're in the money, you're not going to need as large a drop to become profitable. And again, as you can see in the case of puts, farther out of the money means as prices go down. So in the case of a put, everything up here would be in the money, things over here would be at the money, and things under here would be out of the money, meaning that if time passed and volatility eroded, an option down here having no in-the-money value would just erode and expire worthless, barring a move. So now we can just take a minute again and go to our calculator for the actual transaction, and here's the table. As you can see, you have your break-even on the futures, and let's see where that would be. And this is assuming a premium value. Again, we input this early, and it's a higher cost. The option's actually cheaper than what we put in. So we're definitely not trying to make these trades look good for people to do them. We're really trying to just demonstrate where they are. We're actually overstating the cost of this option at this moment because we put it in before the settlement. So here we're looking at a trade where your maximum risk is $605. This includes all your commission and fees. Your futures break-even is at 427.9. Call it 428 just to be simple, which is not that bad when you're at 433.5. You get a half decent drop here. You get this market to 425, 420, which is not crazy, and there can be intrinsically a nice gain even without additional volatility and so on. Again, if the volatility goes up as we discussed, and this thing goes down 3 cents, but there's all kinds of increasing volatility, that option could already be sufficiently profitable to offset, and that's where you have to pay attention. Now, why is somebody paying this extra money in addition to the intrinsic value of 6.5 cents? Why is money to be short or to buy a put? Well, it's very simple. Again, your risk is strictly predetermined, and that's why you pay a premium. You pay a premium to reduce your risk and still have a shot at being short now in this market. And as you can see, when you look at the numbers, because the option is in the money, you don't have to get very far to start making profits. You start considering your initial cost at 425, at 410. For a very short time frame, you have a pretty nice net considering the initial outlay. And as you can see on any sort of a rally, your risk is predetermined. Again, I would suggest, because you can offset options early, you should have a plan that if you are going to risk $605 total on a trade initially, and you don't see the market doing what you expected, it would be wise to walk away and try to see based on the premium or less or whatever the case may be, and not wait for an option to become worthless. On the other hand, because it's a low volatility situation here, as you can see, the market, there's some kind of a supply shock or big supply out of South America. You can see some pretty good numbers on the drop. But let's see what the difference then is between that 440 put, which is in the money, and a 430 put, which is slightly out of the money. Let's just go back very quickly to the chart. And as you can see here, anything under 433.5, which is where we settled, is out of the money. So 430 is out of the money, but not by much. It's really a close to the money option. It's not an at the money option. And of course, we've seen the market even recently go well under there. So I think a person might look at this and say, well, I've got some room here if they're bearish. But let's find out how much of a move they'll need. And again, as you can see, the 430, which is in the money, is more expensive. As you start going out of the money, this option settled at 4 7/8. I believe that we put in a higher price, so we're going to call it 5. Let's see what we put in as a default for the settlement. Now, as you can see, this 430 is out of the money. So whatever this option settled at has 0 in the money value. If the 430 option expires today with a market at 433.5, this would be worth 0. So all of the money that is being paid here is out of the money value. Not far out of the money, but nonetheless out of the money. So the market needs to overcome all that, and people are paying for this, are paying strictly for the time that remains in the option to make the move that they expect. Now let's see if what this particular person would be expecting is at all in the realm of possibility. So again, we're looking at the 430 put. We came closer on this one. We have it at 5 points. So again, we're overpaying a little bit against the settlement, but it's an illustration. And as you can see here, the cost is less. The person's maximum loss is 305, so they're spending, instead of 605, spending a lot less on the option. But what happens? Well, their premium break-even is also less. It's 6.1 instead of the other. The futures break-even, they need a bit more of a drop. They need the market to get to 423.9, let's call it 424, which again is not an absurdly big number, but for some reason the market seems to be discounting that it's not super likely, which is why these premiums are where they are. And the person's maximum loss has gone down because they bought a cheaper money, slightly out of the money. They need a larger move to break even. But on a percentage basis, if they get their drop to 410, or some of the more in-between numbers, their percentage returns are better, but the move that they need in order to become profitable is larger. And the same would be the case. The farther out of the money the put buyer goes, the larger move he would need. Now, some people look at this thing, they might say, well, seasonally corn's going down, so maybe it's going to make a big move. Maybe South America is going to have a massive crop, and there is some seasonal pressure in February, or maybe they say, well, farmers have to pay their taxes at the beginning of March, and they have to seasonally to get the right amount of money. So that's where some people get ideas to be aggressive and speculate, and all of a sudden you see that, again, on a cheap option like that, if you get a move, let's say, to $4, it's $11.95, almost $1,200. The maximum risk is $305, even without cutting losses. So somebody can afford even to be right half the time or 1/3 of the time, and with these kinds of odds, the trades can work out for them if they do it selectively and with good timing. Again, the big enemy of this trade is time erosion, because if the market stays flat or it goes up, these options, which don't have a lot of time left to expiration, will erode. On the other hand, these are also the home run options that if you get some kind of massive surprise or shock in the market, people who buy these kinds of options and perhaps lose more than they win can have a panacea of gains when they hit one of these long shots. So as you can see, again, this gives you a good comparison of how much you're risking, where you need to salvage, and what we would do along with doing these trades is we would suggest that everybody have a stop level where they come out of the trade. One other thing to suggest is that in using the option range, or in many cases you might get a market, so let's use this example, and let's say that this market took a drop, let's say to 420, which might be which would be a profitable level on this trade. Rather than offsetting the trade, if there was more potential for a drop, in addition to holding on to the position, one could also look at legging into a free trade, and that's when you would go back to our option ranger calculator and do some other comparative strategies, perhaps selling another put to leg into a free trade or into a small credits trade as the trade moves along. And again, in our strategy gallery, as you get more and more familiar with it, you will have such follow-ups. So let's say if we have an expectation on a trade, and let's say we're in a long put, and we're already in the trade, and again, the trade was for a drop with rising volatility. If that drop occurs, and now our expectation is that the market has stopped, or that may be driving, but with stable volatility, we might go ahead and turn this trade into through a follow-up strategy into some other kind of a trade, maybe by selling a put, doing a put spread, or some other sort of an adjustment strategy where you can take some money off the table and still give yourself room for the strategy to run. So this was a general introduction to looking at in, at, and out of the money options. To summarize, the principles are if you're expecting a smaller move and you're buying an option, you want to be in the money. You're still looking for rising volatility. If you think the move is going to be, the greater your expectation of rising volatility, the more explosive you think the move is going to be, the farther out of the money you can go with the options that you buy, whether it's calls or puts. Conversely, if you are a writer of premium, then and you are writing options, you want to write them as far out of the money to have a margin of error. You will collect more by selling options closer to the money, but again, the closer to the money they are, the likelier they are to possibly go intrinsic, and then the writer of option, unlike the buyer of options, would be at a disadvantage. So these are two opposite sides of the same coin, but understanding the class of option and the importance of volatility in deciding whether to do something in the money or deep in the money, at the money, out of the money, or deep out of the money becomes your tool and your decisive strategy to implement your volatility expectations. If there are no further questions, I want to thank everybody for attending. There's going to be a repeat on this on one of our demo videos, and if you haven't seen our previous sessions or demo videos on how to input strategies into the Option Ranger, please be sure to request them from our customer service desk, and we will get those out to you as quickly as possible. Thank you all for attending. I wish you all very happy trading and a great evening.
Thank you, Mr. Mueller.